All right, welcome back. We're going to continue our series on the Berkshire Hathaway's annual meeting summary Q&A. Okay, and if you attended or you listened to our last episode, we did a lot of kind of housekeeping and talking about the lead up to this and the two people that are so instrumental in my business career are Robert Kiyosaki and Warren Buffett. And so today we're going to continue this series. I don't know, again, like I said last episode, I don't know how many episodes we're going to do, but there's 48 questions. We're going to try to go through all 48 unless we start finding that there's some repetitiveness. Like I said before, and I've said many other times, I haven't pre-read the questions and answers. I have no idea. I want to go to this and be as live as I possibly can, getting my thoughts, my initial reactions and comments off this. I feel that's as real as possible. I don't want to manipulate the conversation, the dialogue that you and I are having. Now, I say conversation, you're not really talking to me. I'm doing all the talking here, but you are thinking about this stuff. You are listening to what we're saying and you're translating it into something. You have this self-talk of, does this make sense for me? And can I do this for me and my business? And can I do this? And what are the consequences of it? So I want to make sure this is as live as possible without it even being live. Okay. Now, what we want to do is dive right back into this, and let's talk about, we're going to continue this episode with question 3. Now, remember, the ordering of the questions was there was a lot of pre-asked questions that were submitted to Becky Quick. She's a CNBC. She kind of emceed this. And then there was audience, and they're going back and forth. So the last question 2 was the audience. Now question 3 is Quick, some pre-submitted question. Last year, I asked you about how Geico and BNSF appeared to lose ground in their leading competitors Geico on telematics and BNSF on precision scheduled railroading. Now, Ajit and Greg, how is Berkshire addressing these challenges? Okay, so Geico, is the insurance, auto and home insurance, and then BNSF. What is that? That's the railroad company that Warren Buffett bought at the financial crisis. Okay, that purchase, $61 billion purchase, is what took him out of the too big to fail and brought him back into the normal, hey, you're just a average business. Now, here's what's interesting: Geico on telematics. Okay, I'm presuming that this is the technology and the information based on discussing on the telephone and technology. Okay, BNSF on precision scheduled railroading. My assumption is based on also technology. So let's listen to Ajit Jain, talk about Geico. He's the one running the insurance, and then Greg Abel will talk about the BNSF. Okay, so Geico has introduced telematics for pricing on 90% of its new business. Unfortunately, less than half of that is being taken up by the policyholders. Geico's technology needs a lot more work. It has 600 legacy systems that don't talk to each other. Okay, what is a legacy system? So what this means is, as Geico has grown, they have 600 different types of systems, technology that aren't talking to each other. So this happens a lot when there's a merger or a acquisition of another company. You buy this other company, and what do they have? They have technology. They may have a special CRM, a client relationship management system, or they may have a special software that manages the process and the accounting. Okay, and then all of a sudden you buy them, and you have your own CRM system, you have your own processing system, you have your own accounting system, and now you just brought in this other company, and now you, instead of 3 systems, now you have 6 or 7 systems. Okay, this is how this occurs. It becomes an issue. This is a big issue as companies grow, is how do you integrate these softwares without interrupting the flow of business? This is really, really important. The bigger you get, the more legacy systems you have. So he goes on to say, in terms of matching rate to risk, Geico is still a work in progress. And I think that's true for all insurance. matching rate versus risk, the cost of insurance and the risk, because especially in auto insurance and homeowners insurance, because you have to deal with natural disasters that occur, and not even natural disasters, but just normal storms. Different parts of the country have different type of weather patterns. There's a mass shift in population since 2020 to now. So you have a lot of people leaving other states, predominantly Democratic states, that are moving more inward to more conservative Republican type states. That affects rate and risk. That's very difficult because rate and risk in your pricing is based on actual numbers. So when do you know you have to review your numbers? When it's already happened. So you're already behind the 8 ball based on how it's designed. So you try to, as you look at all the numbers, you try to project or make assumptions, educated guesses, but it's art and science because of everything we just talked about. Now, there is a trade-off between profitability and growth, he goes on to say, and we are going to emphasize profitability and not growth, okay? That's important to understand. You don't need to grow to be a better business, okay? You do need to focus on your cash flow and your profitability, okay? Now, there are certain areas where you can grow that affect your profitability in a better way than not growing, okay? But that's what management does, right? They look at their situation and say what makes the most sense. They may not want to grow in Florida and California because of more natural disasters. They may decide, hey, let's grow in other areas of the country and try to figure out how do we take more market share in those areas of the country. And that slow growth improves profitability because claims drop or the severity of claims drop. Okay. So let's go on. He goes on to say, and that will come at the expense of policyholders, which is absolutely true. Okay. It will not be until 2 years from now that we will look back on, we'll be back on track. So again, what I say, when you have numbers, it takes time. Those numbers have to occur so you can review them, understand them, and make decisions. And by the time you make a decision, there are other numbers that have occurred. So you have to figure out this and try to get on track in the sense of how do we predict some of these things and what that looks like. Now, again, remember what Warren Buffett and Charlie Munger had said, we make bad decisions all the time, but we don't make emotional decisions. Okay, so this is it. Okay, this is an example of that. Now, Greg Abel goes on to say, we will focus on delivering long-term value and service to our customers regarding BNSF. So, well, there you go. And what he's basically saying is that, you know what? Even though our competitors are gaining ground on precision schedule railroading, we need to focus on our long-term value and the service that we provide our customers. Okay, so with good service comes good value. With good value comes good service, and that creates profitability. So I love this short and sweetness of it. Now, Buffett goes on to say, Todd Combs was Ajit's choice and my choice to go back to Geico to work on the problem of matching rate to risk, which is what insurance is all about. That's what I said. And he arrived with exquisite timing. Right before the pandemic broke out and all kind of things changed, Todd is doing a wonderful job at Geico, and he works closely with Ajit, and he has a home in Omaha. He comes back here and we get together on weekends sometimes. He's made a very big change in multiple ways at Geico. Now, this is important. He has a home in Omaha and he comes back here and we get together on weekends sometimes. The importance of this has such a dynamic effect on Geico, okay? Because what's happening is he's coming to the master, so to speak, coming back home. He's in the environment. He's in the master's palace, so to speak. And you get wisdom from that and just sitting and listening and discussing and working through things. And by getting that information has allowed you to make a very big change in multiple ways at Geico. Berkshire Hathaway's specialty has been very successful under leadership of Peter Eastwood. This is another insurance company within the Berkshire Hathaway 10 insurance companies. All right, question 4. This is from the audience. What are positive and negative impacts of AI and robotics? Well, we're jumping right into it in question number 4. So, BYD's factories. So this is Munger. Munger's responding. BYD's factories in China have robotics at an unbelievable rate. We are going to see a lot more robotics. I am skeptical of some of the hype that has gone into artificial intelligence. I think old-fashioned intelligence works pretty well. So what did I say earlier? These guys are very, very smart. They're very predictable because of how they process things, right? What I said in the last episode about how, how they're going to approach AI is how they approach technology. It's not because I pre-read, it's because these guys are predictable. They've laid out a formula of how they look at things. That's the whole point. Why don't more people model these guys? I don't know. But BYD is a manufacturer. They're a developer, a producer of robotics. So I think robotics is going to be phenomenal. We have seen automation and robotics over the last 2-3 decades help improve areas of manufacturing and certain other areas of our life. We're even starting to see in some of the vehicles that are day-to-day vehicles that are on the road where they have some form of ability to drive, self-drive. You can say that's robotics, or you can say that's artificial intelligence. Either way, the two combined are going to be a game changer. Now, are we worried about Terminator and movies? Absolutely. This is why I think AI needs to be handled very, very judicially. This is very important because even though he says, I think old-fashioned intelligence works pretty well, that is true. But the point of AI is to be able to take that old-fashioned intelligence and be able to process it on a commodity style process, meaning that any simpleton can have access to all of Munger and Buffett's wisdom in a millisecond. Okay. The key here is, how do we deal with old-fashioned intelligence with experience and emotions? The predictability of how people act or react to certain things. Those are all data points that go into the artificial intelligence and the algorithms, which will eventually, the point of artificial intelligence is to evolve by adding that stuff, okay? Now, Buffett goes on to say, there won't be anything in AI that replaces Ajit. Well, that's sweet, right? When something can do all kinds of things, I get a little bit worried because we won't be able to uninvent it. Absolutely correct. AI can change everything in the world except how men think and behave. And that's exactly what I was just talking about. Now, the theory of AI is that it should be able to. It just needs more data inputs, and it needs more memory algorithm and more testing, right? It just needs a little bit more time. Just like men today are smarter today, or the younger generation have been able to absorb more information than I did. I'm 48, and which then my mom and dad and parents did, and their parents, right? We have access to information, so we're able to process information at a younger age and absorb it quicker. And so that's the same thing going to happen with AI. All right, now question number 5. This comes from the pre-submitted. What is the outlook of commercial real estate and its impact on banks, and is Berkshire active in this area? So good question. So Munger answers, Berkshire has never been active in commercial real estate. The hollowing out of downtowns in the U.S. and elsewhere in the world is going to be quite significant and quite unpleasant. I think the country will get through it all right, but it will often involve a different set of owners. Okay, so what he's saying is, you can look at when coal towns that had a coal mining. You can look at steel mill towns. You can look at a lot of the towns across the United States where that active business or industry had multiple properties or real estate and buildings in those areas. When those businesses went out of business, those pieces of property became vacant. There was no new owner that could just come in and take over a steel factory unless it was a steel factory, right? So that's what he's saying without saying it, is that, the hollowing out of downtowns in the US and elsewhere, meaning small towns as well and around the world, is going to be very important. Downtowns tend to have more high-rise office buildings, that sort of stuff. And so when you had things like COVID and the, in 2020 and people going home and working remotely, there was, everybody worked remotely. And there were certain industries where you just couldn't do that, right? But now we've had some time aside from that, and now we're starting to see productivity drop. And so what are a lot of these businesses doing? Hey, you got to come back to the office. Not all buildings and not all businesses are doing that. Okay. And so this is going to be effect. But just like Munger's saying, we'll get through it. We always have. It just there needs to be a changing of the guard, meaning a new set of owners that buy those properties and think differently of how that particular property or that particular real estate is going to look in that environment. Buffett adds, the lenders are the ones that get the property. And of course, they don't want the property, right? Lenders lend money. They don't want the physical property. They just want to leverage that property as collateral. So you pay them. They want the interest. Okay. So the real estate operator counts on negotiating with them, and the banks tend to, extend and pretend. But it all has consequences. And it's right. So what he's saying is that, look, banks are going to act like they may be bigger than they are. So they may overextend and lend money to a particular type of business or for a particular type of loan in real estate that's not necessarily in their wheelhouse or comfortability. It's going to have a consequence, possibly. And we're seeing that in some areas of the country and some areas of the world. Okay. One last question, question 6. This is from the audience, and then we'll stop this episode. How can investors succeed with disruptive technologies and AI? Well, Munger responds by, value investors are going to have a harder time now that there are so many of them competing for a diminished bunch of opportunities, which is actually correct. I'll get back to this. My advice to value investors is to get used to making less. Well, that's pretty wise advice. But here's the interesting thing. Value investing, and why is he talking about this? Because we're becoming smarter. There's an evolution of businesses, and he's saying there's not a lot of value in some of these. There's an overvaluation in a lot of these businesses and stocks, and so it has diminished these opportunities, which means you're going to make less money. So as a value investor, you got to either be better at your research and be the first to the opportunity, or you need to shift some of your mindset of how do we change or diversify some of our value investing, or get used to making less. Okay. So Buffett adds, well, we never thought we could manage $508 billion. There are going to be plenty of opportunities. What gives you opportunities is other people doing dumb things. Opportunities will be greater if you are running small amounts of money. So this is phenomenal. Okay. Yes, they're managing $508 billion, but Buffett and Munger are not managing those 67 businesses. They buy good businesses because of management as well. And so they're running themselves. So what's happening is that when there's opportunities, when people do dumb things, is that, Buffett's been on record saying, hey, we're like salmon. When we see people buying, we're selling. When we see people selling, we're buying. Right? Do the opposite of the masses. Opportunities will be greater if you are running small amounts of money, meaning that you're more mindful of the opportunities. You don't have more money to just go waste and be willy-nilly. Where that's what's impressive with Buffett and his team, is that they've done such a good job with so much money that they're not just they're staying very, very disciplined. That's impressive. So Munger added, there is so much money now in the hands of so many smart people, all trying to outsmart one another, and are short-term oriented. And that is the number one thing I want to leave with you that I think is such a phenomenal point. So many people are looking for the quick, looking for the instant gratification, not allowing. This is why my second book that we just published called Farming Assets, that's the point of it, is that how do assets mature? And I use farming and crops as an analogy that just like if I want to plant strawberries, I'm going to yield strawberries within a few weeks, a month of planting them. But if I want a orange, I'm going to have to wait some time because I got to plant the tree. It's got to grow. It's got to be able to mature and nurture to where I'm going to get a orange. But the beautiful thing about the two different things is that once you have the strawberries, you pick them, that's it. It's a transaction. The next season, you're going to have to plant again to get strawberries. Other than an orange tree, once you plant it, it's going to bear fruit every season. You don't have to replant it and wait that time frame. It's just going to occur. Okay. So Warren Buffett and Charlie Munger are the citrus tree. They're the almond tree. They're the grapevines. All right. They're waiting. They're planting. The thing about them is that they're using capital to go buy fields of citrus trees, as an example. They're going to buy a very profitable or cash and fruit bearing asset that yields them fruit without having to wait for the time to plant it and for it to mature. So very, very important aspect of building assets. So thanks again for joining us. Join us on our next episode, and we're going to continue to go through this until we get through all 48. Thanks so much. Make it a great day.